Okay, well, I'd like to kick off just with a brief introduction. My name is Richard Lance, and I am a partner at Harris Trotter, and we specialize in the Web3 and digital asset industry, specifically around accounting, bookkeeping, audit, tax advisory, etc. To the right here is Nick.
Nice to meet you, everyone. For those of you who have joined, thank you. So yeah, I am one of the managers here at Harris Trotter within the digital assets department. Been here for about 1.5 years. Trained at PwC before, so yeah, we're both chartered to qualified accountants. And I guess how long have you been with the firm?
I've been with the firm for just short of 2 years now. Joined. As I say, when the team was still decently small. My background was, I'm from South Africa, and where I studied my chartered accountancy, CASA. Moved across to New York for a bit, for a stint just before COVID, and before moving across to London, where I joined BDO, and then came across into Harris Trotter to specialize in digital assets.
So just by way of background, so Harris Trotter, we're located in London, in the UK. Unlike, I guess, a lot of firms within the Web3 space, we're not actually a startup. The firm's been around for 80 or so years, but in 2017, we made the move into the crypto space, and we've been massively growing now to a team of about 35 people. We've got 5 juniors, which we're training up to be just pure crypto accountants. We work with about 400 to 500 crypto native clients all across the globe. So not just within the UK, but I'd say about 60 to 70% of our clients are overseas. Some of those clients that we work with include the likes of 1inch, Wintermute, blockchain.com, BitFury, the Sandbox, just to name a few. So yeah, been a really exciting journey to be part of H&T here. And yeah, I think in terms of what we want to discuss, I don't know if you want to give a quick.
Just to add to that, our team's built as about 35 people now, which I'm sure most of you would have found out that it's actually quite difficult to hire people specializing within digital assets. And I think that's kind of where our biggest strength lies, is that we've been able to handpick some of the top quality staff that we have from the big 4, big mid-tier firms that are digital assets, had experience in their own right, not necessarily in a professional way, but self-taught, etc. And this is definitely our competitive advantage with the knowledge that we have across the team. So it is very exciting, and we are growing at the moment. We're growing basically 1 to 2 people a week. We're trying to do it organically, just to ensure that the training is in place, and the level of quality is never dropped.
Definitely. Okay, I guess in terms of general structure, I think we're just going to have a quick overview for those of you who are not aware, sort of what crypto accounting is, what makes it different, also from the audit side, and then I guess just a few general points, problems and challenges that we see as accountants, questions that clients ask us, that new joiners ask us. So Rich, I don't know if you want to start maybe just having a quick rundown of what actually makes crypto accounting and audit different to the traditional space.
Sure. So, having come from traditional side and spent 10 years in that, in the traditional side of audit and accounts, there is a big difference. And I think this is where, a lot of people are scared to enter it or struggle to adapt it. A lot of this has to do with there's actually no clear accounting or audit standards or guidelines. It is quite a grey area, although the grey area can lean towards a more insightful, and it's about the application of the standards rather than having a standalone standard. because there has been talk about should there be an IFRS standard for digital assets. However, as we've come to know, that that the industry isn't just one shoe fits all. There's inventory, there's intangible assets. Is it when you start getting SAFs and smart contracts and how revenue recognition, etc. So one of the big things is actually having a deep knowledge of the standards and of the accounting principles and applying this to the specific scenarios. No one company is the same. So this is somewhere where we do specialize in, and again having this team of highly qualified professionals, we are able to discuss this and challenge each other and really dig deep in applying accounting policies and principles to the industry. So this is definitely somewhere I know you're part of it a lot.
And I guess just to add to that, I think there's just an additional layer of working with large volumes of data, working with complex types of data, right? I mean, half the battle in crypto accounting is actually getting all your transactions together from a variety of different chains, from centralized exchanges with very bad API outputs, actually ensuring that your information is complete and accurate, being able to look at a transaction on chain on a block explorer and actually understanding the nature of it. These are all sort of requirements that wouldn't have been seen in a day-to-day of a traditional accountant, right?
And it's about the completeness of the data. So we know the ledger's on chain, the ledger's there, the information's there. We know it can't be manipulated, but actually having access to it and pulling it off and ensuring that you are pulling off the correct data. Around staking rewards. When were these earned? When were these claimed? Have rewards that have been earned been left on chain and unclaimed? What are the consequences of this? With your wallet, have you ensured that you've got all the tokens cross chain? Has it been wrapped? So again, we know the data's there. It's just about actually building the technology to actually extract this. And I know there's a lot of tools that we're using, sub ledgers, which are really important and assist us greatly in this. But with the ever-growing blockchain and all the protocols, we are having to build a little bit of our own technology and being able to pull that data and actually do manual reconciliations. So I think that's so difficult.
Yeah, exactly. And I mean, it's like you highlighted, it's such a fast changing environment. So to be able to understand how to account for these issues, you actually need to be able to stay up to date with the latest technology trends, right? And like you also mentioned, the use of subledgers, the use of various softwares, you need to be very versatile and adaptable to be able to actually use these different softwares, these different systems, and to basically get to the point that you want as an accountant, which is in practice, right, just converting all your blockchain data into a readable financial format.
Yeah, and another thing is, a lot of what to do with blockchain as well is, the pre-launch of the tokens or pre-launch of the blockchain, where early stage SAFT agreements. You've got to account for all of these contracts and agreements that have been entered into, and then ensuring that a year, 2 years down the line, or if there's lockup periods, are you actually tracking this? Do you know when these tokens have been launched? Have you received the tokens that actually are due to you? If you have an agreement that's telling you're going to receive 500,000 tokens in 3.5, 4 years' time, when that period comes, how do you know that this has been received? How do you remind yourself where has it been launched, etc.? So, there's a lot of off-chain activity as much as there is on-chain. So again, it's all about building those tools and those strips and a system to account for all of this.
Yeah. Yeah, agreed. I think, I mean, we could talk for days about what makes crypto accounting unique, right?
I think, you know, what we've done here is we've limited it down to a few areas. What we believe are, you know, critical to everyone, and just things that, you know, people from startups or traditional firms, you know, should be thinking about. These are kind of frequently asked questions, key risk areas, etc., and just some good tips that we want to share with everyone. So we've got about 5 or 6 little topics here that myself and Nick will run through and add to it. And yeah, so I guess the first one here that we're going to chat is, and Nick's going to tell us about it, is just wallet hygiene. What is actually meant by this, and you know, what's the importance of it?
Yeah, so I actually think it's an incredibly important point to consider when you're setting up a company. You know, when you're thinking about how to structure your crypto, it's the idea of actually ensuring that, you know, the wallets are, you know, at the end of the day, usually what we consider the ownership of the company, and it's our way of making sure that we have a complete data set. So within that, actually ensuring that all the wallets belong to the company. You know, the amount of clients that we've taken over, we've seen there's a wallet which has a shared ownership of, you know, the director and the company, or maybe 2 different entities within the same group are sharing some of the assets. It becomes incredibly messy because from an accounting perspective, the ideal case scenario is that you have, say, 10 wallets, and 100% of those 10 wallets belong to your company, and that way we can easily track what's incoming and what's outgoing and what the closing position is. To then go on, if we then have a way of actually differentiating our wallets based on, say, operational nature. For example, we have wallet A, which pays all our contractors, wallet B, which receives our income. We can then actually, as accountants, easily say, okay, anytime there's an incoming transaction into wallet B, we know that's an income, right? So it actually creates a much more efficient and effective workflow, and we can set up our own automations, our own rules to then account for that easily, right? And, you know, where we have clients who have thousands, hundreds of thousands of transactions every day, we don't want to be having to spend time to go through each transaction individually. So where we can, if there are sort of generic rules or automations that we can follow, it makes everyone's life a lot easier. So what we would say, you know, if you're unsure, if you want advice, if you think, okay, I'm going to set up some new wallets, you know, speak to us, and we can offer some advice on how to make your life easier down the line.
Yeah, I think to add to that, Nick, is, you know, having done a lot of historic restoration for a lot of our clients, and you know, and clearing it up and putting in the correct controls. What we find is in the beginning, you know, people are a bit scared, and you know, they're launching it, so they feel security around one wallet. So this wallet will pay for payroll, it will pay for contractors, as you say, it will pay for ad hoc services. It will have their trading in it if they've, you know, swapped tokens on chain. It will have stake tokens. It will have staking rewards received, income received from services rendered. And, you know, they believe that, you know, if they keep it all in one place, it would be easier to manage. But in retrospect, that becomes the nightmare that we, you know, I guess we love to see and we specialize in. But we have to go through that, and it's very manual, transaction by transaction, as you stated. You know, and one of the controls is kind of, once we've got that up to date, is, you know, it's not about having 15, 20, 30 different wallets for different things, but it is just trying to group, you know, have an expense wallet, a payroll wallet, you know, a staking rewards wallet, and you know, and having these different wallets, and then from a you know, a high risk perspective, you know, having that treasury wallet where, you know, with these sub wallets, when they get, you know, over a certain amount, is transferring those assets across to your treasury wallet, which is, you know, a lot more secure and not used as much, and has a lot more controls around. You know, that's agreed, you know, certainly something that we do implement, and we you know, we recommend to everyone is, like, think from day one, keep your wallets clean, keep the, you know, you are going to have to do accounting. A lot of people in the beginning say, oh, you know, we're only going to be needing to be audited in maybe a year, 2 years time, 3 years time. But it's a lot more difficult to go back and, you know, clean up, rather than just ensuring that those good healthy controls and wallet hygiene are in place from day one. It takes a bit of effort, but it's a lot easier to keep it clean than to have to go back and clean it up.
Right. All right, then I guess on to our next point. Slight change of topic, but a very crucial one nonetheless for crypto accounting, bookkeeping, auditing, everything. We often, you may have seen this buzzword called the cost basis being thrown around. So Rich, what exactly is the cost basis, and why does it matter so much?
Yeah, cost basis. I know everyone who joined, we would always reiterate how important this is. You know, this cost basis, and you know, basically that is the key thing that we're looking at. So basically, what the cost basis is as simple as that. What is the cost of the tokens that have come in? This cost basis will change as and when the tokens come in and out, but it allows you to calculate your gains and losses, or your unrealized gains and losses, and then that will help assist you. You know, so it is a right topic here, but if we're looking from an accounting perspective, if you follow the cost basis approach, you will hold your tokens or digital assets at cost on your financials, where if you're doing it on the revaluation model, you are going to be revaluing it then weekly, monthly, quarterly, annually, depending on how often you want to do it. But your cost basis is always going to be your starting point, and you'll then revalue it up, have some unrealized gains, or if you're revaluing it down to that cost basis. So again, and then from a tax perspective, that you're always going to have your capital gains, etc., from this cost basis. Now, you know, you would think that it coming through it, when it's tracking those tokens and actually keeping track of that cost basis. You know, and there's different methods. You have the weighted average cost, or first in, first out, or last in, first out. So this is actually quite a complex area, and you know, we do use a lot of sub ledgers to assist us with this cost basis tracking and allocation, etc. And our first point in anything is to always just go and, you know, we pull the transactions from the ledger, we recalculate the cost basis, we do sampling of this recalculation of cost basis, we recalculate the cost basis of inter-wallet transfers. You know, it's one thing tracking the cost basis from when the token comes into my wallet to when it goes off to a subcontractor for payroll or something like that. But you know, what happens if I transfer it from wallet A to wallet B? You know, you can't be making gains from your wallet to your wallet. So, you know, that token has to transfer at its cost basis and enter the next wallet at its cost basis. So these are, you know, these are foundations of the accounting, ensuring the accuracy of it.
Yeah.
And these recons are super important.
I think, yeah, it is essentially the foundation, right? Because like you said, you know, it's going to have to be disclosed on the balance sheet. You know, those of you who are familiar with the IFRS standards, even, you know, even if say you hold your crypto as inventory or as an intangible, you're still going to need to disclose the cost, even if, say, in the case of inventory, you're still going to need to do it at a lower cost and net realizable value. So you need to know the cost. If you do the revaluation model under IAS 38, you still do need to disclose the cost. So
it's everything.
There's no
taxes,
depending on your tax territory, you will need to determine your cost to figure out what taxable gains you may have.
Even from a management perspective, you know, I know a lot of the finance team are always, you know, trying to do it from an accounting perspective, and then at the end of the quarter or end of the month, there's senior managers who are, you know, doing investment decisions and direction for the company. The first thing is, well, you know, where do we stand from, you know, where do we stand? What did we buy our tokens for? What is the fair value at the moment? Have we made money? Are we in a loss position? You know, so again, that's all the, you know, decision making is around is cost basis, fair value, you know, strategic direction. So very, very important part of it. And, you know, identifying that, I guess from every user out there, is identifying what method you are going to use and try to keep it consistent. You know, if you're going to go the weighted average cost per wallet per token, or, you know, universal weighted average cost, or the first in, first out, it's about identifying that and then sticking to it. You know, you don't want to be changing your cost basis on the annual basis, because this is just going to throw all your accounts out and you know, and really cause a problem, and you'll have to restate historic numbers, etc. So, you know, it's identifying. I know in a bull run, it's kind of, you know, first in, first out, or last in, first out, because that's going to show the biggest gains. And then as soon as it goes into the bear market, then everyone's saying, oh, now look at all these big losses. How do we, you know, even that out? So I think traditionally what we like to do is we like to use a weighted average cost. I think this is just a more stable and really, you know, across multiple periods from an accounting perspective. And then depending on how you want to do it, there's the argument between weighted average cost per wallet per token, or a universal weighted average cost. Again, no real difference, or, you know, which is better or worse. I think in the beginning we used to do it per token per wallet, but, you know, as the technologies and the subledgers become a lot better and more equipped, you know, I believe that these methodologies will change going forward, and we've got to be open to change.
Yeah, no, agreed.
Yeah, so I mean, like you mentioned earlier, automation, when you're talking about that wallet hygiene, and you know, what does automation mean? It's a big word thrown around. You know, you do a lot of it for your clients, and, you know, it's assisting them in their day-to-day. So, you know, explain to us, you know, what is automation and what does it entail?
Yeah, sure. So, I mean, automation usually means that, you know, you have a system that sort of does what you do on a manual process automatically without any sort of individual inputs each time, right? So, for example, when you have 1,000 transactions to label, instead of going through and, you know, whatever subledger you may be using, going through and adding the label manually, you have a tool, an algorithm, a script, whatever you may call it, that does that for you, right? Just based off some very, very simple inputs. Now, what we realized pretty early on in the crypto space, as we mentioned before, is, you know, you have a very unique nature of a lot of clients with large volumes of data, with weird volumes of data, weird natures or weird transactions in general. So what we've been doing is we've been very technology focused here at H&T. We have an in-house development team where we basically, you know, we speak to them as accountants. We say, okay, this is our issue. This is what specifically needs fixing. They will then tailor a script or something of the sorts to it and actually make sure that we can either automate a task, such as, you know, the labeling of transactions, such as automatically detecting, I don't know, say for example, a staking reward. Say for example, in other cases where we have market makers as a client, that we calculate their revenue on a net basis each month. It's these kind of processes that are not done easily, you know, as a manual task. And instead what we do is we, like you said, we automate just to make our life easier, just to actually digest the data that we're given, so that we can actually put our focus on the real sort of complex accounting issues, rather than just dealing with bulk amount of data and doing the same job over and over and over again. So yeah,
so repetitive transactions, kind of,
that is one
machine learning, you know, a repetitive transaction. This is what it is. If you see that same transaction on and on, it automatically applies that label. I mean, you went through the different clients there, and I was thinking to myself that, automation, although it sounds easy, oh, we can just apply to that transaction, but what it requires is an in-depth understanding of, of our clients and what they actually do on a day-to-day basis, what their transactions look like. And, what we do in the beginning when we onboard our clients and we sit there with them, and, we really go in depth. And, this leads on to our next topic, which is going to be audit readiness. But audit readiness is not just, it starts with the bookkeeping and the automations, etc. And it's about, creating those internal cycles and around their revenue. How does their revenue work from beginning to end and land up in the financials? And, when you have an in-depth understanding of your clients and you know what they're doing, this is when you're able to automate, and, because where those transactions are going, the type of transactions, what those transactions mean, etc. So, it certainly sounds, quite complex to automate. I don't think it is as easy as, I think your life becomes easier once the automation has been done, but certainly that original implementation of it. And then I'm sure it changes as the company grows.
Yeah, 100%. I mean, you've got to adapt to, the different chains that you're using, the different systems that a client may be using. There's all sorts of considerations, but that's why we have been, very much focused on the tech side, making sure that, we do have our in-house software development team that are very dynamic in their responses and able to sort of deal with pretty much any client issue that we face.
I think from an automation side, we do it, and again, it's leaning on audit readiness. We do it from a client's perspective, where we're helping them with their day-to-day transactions, etc. But when it comes down to what we do is about automating our lives and and our work assessment. So from an audit readiness perspective, we could if we're going to do a wallet reconciliation at the end of the year to get it all ready for the auditors and have the audit support, we could take a wallet, go onto Etherscan, do a screenshot of that day, put the web address in, etc. And and then we're comfortable that that token is that value, 100 Ethereum, for example. However, the issue comes in is when our client has 1,000 wallets, which they do, and on each wallet there could be 30 different tokens, and they could be on 5 different chains. And having someone to sit there and go into each blockchain scanner and to go take screenshots is just not viable. So I know that we've got our in-house technical department where we do a lot of our build our own code and softwares, and one of them being to help us with that monthly balance reconciliation. So we're able to put in 1,000 wallets, let's say EVM wallets, and it will go across all the EVM chains, pull every token, pull its balance at a specific current date or historic date. It will spit out the block number at that final time, and the token's native address. And this way we're able to perform monthly, annual wallet reconciliations within 5 minutes, and provide all the audit support, so that that an auditor can come in and has all the where do I go see Ethereum? There's the block number, this is the historic date, this was the amount, this is the token, the native token address, and they can go verify it themselves. Yeah. So I think certainly automation within our work, from doing audits and your bookkeeping, making us more efficient and hitting our clients' deadlines, which is normally a week, 2 weeks after the month.
Yeah, no, 100%. I think that does put it quite nicely. I mean, you've kind of already touched on the audit readiness aspect, I guess. Just on that, it's a bit of a new field, just given the nature of crypto clients. We obviously know that when the crypto space started, it was a bit of a wild west from a sort of corporate governance perspective, to put it lightly. So more and more crypto companies are now seeing that the reality that audits are in the pipeline, or if they're not already having to go through one. So a lot of what we've been doing is actually doing these audit readiness modules for our clients, where we do just prepare them from a sort of documentation perspective, making sure that the systems and controls are in place. Even, I mean, I guess even stuff like wallet hygiene, you know, comes into place there. It's just really making sure that, you know, using our expertise as auditors, that our crypto clients are feeling ready to go through that audit as painlessly as possible.
Yeah, I mean, you try to explain to a digital asset founder, ISO 315. You know, they're gonna laugh at you and say, well, what does that even mean? And you know, at the end of the day, we're the link between the blockchain and digital asset world and traditional finance. And when it comes down to audit readiness, you know, people say, oh, well, we've got all the data here, here's the transactions, but it's more than that. You know, your auditor is going to come in, and the first thing they're going to do is they're going to want to do the under ISO 315 in planning, is they're going to want to do your system walkthroughs and ensure that you have controls in place, and etc. And you know, this is something that we come through and we do in the beginning, and we document all of this and create all your controls and your cycles. And a lot of people say, well, you know, we don't have any controls. But they do, because, you know, no one just has access to your wallet. Or if someone wants to do a transaction, if they want to stake, if they want to do an investment, if they want to do a trade, there are certain procedures that they go through, security procedures. You know, they see it as more as security rather than controls, but these controls are in place. They just don't realize that they are the controls that are there. So it's going in and documenting all the controls, making sure that all of this documentation is in place, that their monthly reconciliations and the process around those monthly reconciliations is documented, and then getting all the support that they have all the transaction data, they have all the evidence, you know, putting it all together, doing the balance checks, ensuring that there's all the wallets are in place, and actually providing a pack. So when the auditor comes, you kind of give them this pack, and which will answer 80% of their questions, and then this makes it more efficient for the client to go forward. And then you know, the other 20% of questions which are difficult, you know, then that's where we are. You know, the auditor asks the client the question, and they forward it on to us, and we kind of show them where it is, how to do it, and provide that extra layer of support, etc. You know, yeah, accounting policies, writing all the accounting policies out, etc. So you know, when we talk about audit readiness, it's not just bookkeeping, it's not just labeling the transactions, it's actually, you know, creating your trial balance, creating the chart of accounts, ensuring that your accounting policies are in line with what you've been doing. You know, drafting the financials, actually having a set of financials there. So there's, you know, we really hold your hand and, you know, take you through that process, and ensure that you can actually pass the audit, because the last thing you want to do is you put in all this effort and then the auditor doesn't, and you know, says, oh, you've got too much wrong, you're not signing off. So yeah,
exactly.
And okay, well, audit readiness, I guess the last thing that we move on to is audit. Again, this is a very big topic. So I think what we break it down into is, you know, what are the two areas within the audit that you see people forgetting about, and what you believe is the most important.
Yeah, I mean, I guess going back to our original point about what makes crypto accounting different, I mean, what makes crypto audit different is you now have this new balance on your balance sheet and potentially some P&L items which are related to your digital assets. So, you know, on one hand, you have, you know, you now have a new asset, new balance sheet. So what we know from the blockchain technology is that, you know, we basically have access to viewing access, right, to all wallets on chain out there, but we don't actually see who the ultimate owner is. So from an auditing perspective, is how are we comfortable that a company isn't just claiming ownership of millions of wallets, right? So what we've actually done in-house is develop our own proof of ownership tool, which more or less cryptographically proves the ownership of the beneficial of the owner of the person claiming to own the wallet. So that kind of tests the, I guess, what's the rights and obligation assertion, right? Then on the other hand, from an accuracy perspective, how are we comfortable that for the on-chain wallets at least, that we have the correct balance as at a certain date? Again, we've created our own tool where we check the balance. I think you mentioned this earlier. We do we confirm balances as at a certain date for X given wallets. And it's these kind of tools that we've had to implement to help us with our audit procedures, to really get to grips with this new crypto side, because it is seen as more risky by a lot of not just shareholders, investors, but also the more traditional auditing firms. That's why they're letting crypto clients go or not even touching it. So that's where we've come in and made sure that we're comfortable from that area. And actually it tends to be the area that we can almost test the best, just because of our expertise and just because of if you actually understand how the technology works, you can actually test near 100% of the data. But yeah, I think in terms of,
to add to that proof of ownership and the wallet ownership tool, traditionally what we would do before we created this, and this is why we saw the issue and the need for it, was that you could ask the client to log in and to send a transaction, $1.5 equivalent of the token, send it from wallet A to wallet B on a specific day, and that specific amount, and then we know, okay, the person has logged in, they've transferred it, and we've just gone to their wallet, and we're comfortable, and then returned it, and then we're comfortable of the ownership of both wallets. The problem that we came in and pushing back that we saw is that one, privacy. Again, people can see all these transactions happening and saying, oh, what is this, who's being audited? But two is around the gas fees and of these transactions and the cost of it, because like we said earlier, we've got clients that have 1,000, 2,000, 3,000 wallets. They're making 3,000, 4,000 transactions. This does become, the gas fees do add up. And then also the time that it takes to log in to every single wallet, do the transaction on the specific date at the specific time, which is difficult. So this proof of ownership tool allows for, bulk and it's going on and signing the transactions, but bulk logging in and not having to actually send the transaction, but signing a transaction on chain, which is cost effective. There's no gas fees. It doesn't register on chain as a visible on chain transaction, but rather signs a note that can only be signed once the wallets have been logged into. So, this just from a cost perspective, it is game changer for our clients.
Definitely. Okay, I think conscious of time.
Yeah, I don't know if there's any questions.
We could go on forever, but
otherwise we will wrap it up here and say thank you very much, and thank you very much for being invited to chat on this platform, and we appreciate it.